All right. Hello, folks. Welcome to Market Trends. I'm David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone on Thursday, May 1st, 2025. Um, I believe I have some sound issues that I'm not sure how to fix with the timeline I'm on, so I'm going to just proceed. I apologize if the sound is not as good as it normally would be. Um, and so we're going to show some disclosures here. I believe it's picking up the wrong microphone, and I apologize for that, but I'm not sure there's anything else I can do about it. So you want to go to tradestation.com, and then you can um, go to the blog post near the bottom of the actual main page of tradestation.com, and it will take you to an article about today's webinar and the main things we're going to be talking about. I'm also going to show you some standardized returns and share some links in the chat. Here's a standardized returns. Some of the ETFs we may be talking about. All right. So here's the standardized returns. All right. So today we basically have the S&P kind of jumping back to where it was when they had the big Liberation Day and all the big tariffs were announced. And there's a few things I want to kind of point out. So first, I have this chart here, which is just kind of, so go to tradestation.com, scroll down, and this article right here, indexes near potential resistance. So some time ago, when it started stabilizing here, we had talked about the fact that it could inch its way higher and kind of fight higher for a period of, a week or two, something like that, and work back toward the 50-day moving average. And that is what it has done. Now it's getting to a point, though, where we have this resistance here. And it's important to realize this was the candle right before. So people were buying that day on April 2nd, and then they got punished after. So it's important to realize that people will view this as a potential resistance zone as, oh, I'm glad I got my money back, and now I'm a seller. So that is a way to look at this market from this technical point of view. Now, another thing is that we have here on this chart, I want to show you this other chart. This shows the NASDAQ 100 with 4-hour candles. Now, this also was Liberation Day, this big outside rejection. And you can see that we're now back inside, back to the top of that range. So that's an important thing to kind of realize also, some potential here for some resistance. Now, another workspace that we've shared with you guys. Now, remember, there's a zip file in the article at the top. There's a zip file, and in the zip file, we have a series of workspaces that we share with you guys. And one of them is, we haven't looked at this one in a while, but it's called MT Hourly Active. And what I like about this workspace is I have found this to be just very useful. And what this does is this basically projects daily MACD onto an hourly chart. And this combines multiple time frames. So this shows 52-week highs when it has those crosses. It's kind of interesting. And then it's an hourly chart, but it will show weekly lows with those kind of little ovals. So there's a lot of interesting things about this chart. What's interesting is, look at yesterday. The market took a dive. It made a weekly low, but look at how MACD was just juicing higher. So this is a very kind of interesting sort of sign of momentum that I think is useful. I want to kind of point that out because I have found that when this blue line, I took basically one of the slower moving MACD lines, and I basically made it the only one that was visible, and I hid the other one. So when the blue line is basically in a period of rising like this with the green histogram, it shows you have this strong momentum. So throughout here, we started having strong momentum, and people who bought weekly lows would have benefited from that. So this is an interesting sort of thing. Now, one of the important things, though, that this chart also has is the RSI on the hourly. And what I have found is that this is also a useful sort of thing to tell you when maybe we're kind of stalling. And this works both ways. The hourly RSI on the cash index, not on the futures, but on the cash index, on the hourly, I have found to be exceedingly useful. So you can see at different times when this hits overbought, it often will signal kind of the end. And even when in a bearish market, when it hits oversold, I mean, you have this incredible sell-off here, but generally overall, the oversold can give you some signs as well that at least if you're short, that you're nearing kind of the end. So I think it's important here to realize that we have a signal here of a potential kind of peak for the time being. Okay, now, so that was the hourly chart, the S&P. Let's look now back on the daily chart here. I want to just kind of point this out. So all these things have basically now kind of played out. And the stochastics now at a spot where it's kind of potentially hitting an overbought kind of stalling. So from my perspective here, we've gotten to a point now where the market has, recovered a lot. And now we're in a spot where it's going to be a focus on the next set of catalysts going forward. Now we have Apple and Amazon tonight. However, in many ways, Microsoft and Meta may have been the two more important ones. I think Apple is kind of its own kind of company. I mean, it's not really a macro story in any way. And it'll be interesting to see what happens with Amazon. There's obviously some optimism about it based on the strong Azure numbers that we saw from Microsoft. But I think the thing here is that this might be a spot where people kind of see resistance. Now, another point that I thought was interesting was that the S&P 500 is up 8 straight days. Now, it has only been up 9 straight days 2 times since the beginning of 1997. So to go up another, maybe it will go up 9 straight days. I'm just saying we're at the spot now, and long term, there's been many times we've seen an 8-day streak to the upside since 1997, but there's only 2 times. I mean, there's probably 10 or 15 times that it went up this long, in that period of time. But it has been very unusual for it to go up 9 straight days. So we're up now a part where people could also see as being relatively extended. Now I calculated that using some things on TradingView. I want to just mention. So then we basically have payrolls in the morning. So let's look over at our rundown very quickly. We're gonna have, we have these earnings tonight, and then we have payrolls, non-farm payrolls in the morning, and then we have the Fed next week. So I think that's just important to realize. All right, now, my sense here is that we're kind of at a point here where, remember, we have our volatility cycle. When basically now we're in a spot where the VIX is falling and there's less correlation. And in my view now, what we could very well see is less movement in the indexes. The S&P might not move all that much, but individual stocks could kind of move on their own, which is what we see at this point when the volatility starts to fall. The VIX now kind of inching down toward 50. So that's kind of, this is the kind of playbook we work with. And at this point, we're in the spot where VIX is falling, less correlation, but it also can mean that the indexes are going to provide less of the actual movement, and it goes back to the stock picking. So as we look forward, I'm going to just actually note one thing right here that I wanted to talk about. I'm going to bring up my Option Station Pro, because tomorrow morning we have ExxonMobil reporting earnings. And now energy is, let's take a look over at our sectors here on our MT main. This is the main workspace we work with to show you guys. This is standardized returns. But if you go to key ETFs and you look, for example, in the last week or two, you can see very much that energy, it's the only red sector in the last week. It's one of the laggards over most time frames here. In the last month, it's interesting to see that energy is by far down the most. So I think what's interesting here is that we have an environment where we had negative GDP yesterday, and today the economic data remained negative in various ways, and I'm going to get to that. We have OPEC increasing production. We have a little bit of tension with Iran today. There was some kind of he said, she said coming out. But when you look overall, we have a situation here with energy where the macro environment could, be viewed as negative. So here we have the XLE, kind of hitting this resistance level. Now, this is exactly what we had talked about in our State of the Market webinar on Monday. And Monday, we look at the indexes, we look at the sectors, and we had basically noticed that this was rallying back to this low, and we had said that this was one that maybe would give some kind of movement to the downside, and it's been kind of happening here. And so now here we have ExxonMobil reporting earnings tomorrow, XOM. Okay, and you can see here next earnings date tomorrow morning. So a person might want to think about, maybe Exxon goes back down kind of toward 100. Well, you can look here at the 2nd of May options. The puts here, potentially the stocks at like 106. And let's say a person thinks it could drop down kind of toward 100. So let's just say something like potentially, you could look here at the 104 puts. Let me just make this a little bit bigger. A person could click here on the ask, which would, indicate a desire to buy. And then you could hold down the control key and click on the bid of the 101s. And that would create an order for a potential vertical spread. And so let me actually get this to work. There you go. Now they should both pop up. So the net cost of this is about 50 cents for a spread that could expand to being $3. So that's a potential return of 400 or 500%, something along those lines, from the stock dropping down toward 101. So that's something that might kind of be popping up for people here. The situation with energy is in many ways, the sort of sector people would look for if they see economic weakness. Okay, so that was the main thing I want to talk about, energy there with ExxonMobil coming up. Now, as we look out further, as we look here at the Fed, I think it's important to realize here that after the Fed and after you get past these earnings, the attention is going to turn to the Fed. And when you look at some of the news we have here, it remains the macro level news not being terrific. So we have a good week. This week the market's up, and there is the bullish sort of overall momentum. Next week, attention is likely to kind of focus on the Fed, and it could be more of a sort of negative, which is another reason here why people might think this is an area where the market might need a little more time to kind of sit, back at the Liberation Day level here and back above the 50-day moving average. And so I wanted to just kind of point out, if we actually look at some of this data we had, it was, the only way to put it, it was all pretty bad. If you look at this, what we saw is basically in the economic data. Let me put myself on screen here. If you look at the economic data here, what we essentially saw was that today's initial jobless claims were higher than expected. The continuing claims were the highest since November of 2021. So that is more of a sign of weakness in the job market. The continuing claims is always something that has, more of a sign of people being stuck out, without being able to find jobs. So that was the claims data. We had the job openings data, the JOLTS data early in the week, which was weaker than expected. ADP private sector payrolls missed. So those things negatives. And then you look at today's Institute for Supply Management. It's very interesting is the export orders absolutely cratered. So just something to think about, this idea of us exporting more goods. Well, if you actually look at the data coming in via ISM, it's not happening. The opposite's happening. However, prices are going up. So when you look at these PMI numbers, the only positive thing in any of them is that prices are going up. And that's not an overall positive, but rising prices in the context of the Institute for Supply Management or the PMI from S&P Global or these other Fed surveys, in those numbers rising prices is viewed as a positive overall. It's viewed as, oh, there's people buying stuff, so that must be good. In this case, though, when you read the reports, they're very clear that prices have been going up because of things involving trade and tariffs and stuff like that. So we have an environment with lower orders, weaker production, higher prices, and in some cases, some signs of weakness in the job side. So all those things are, stagflationary. So it's interesting. We see the Chamber of Commerce. There's an article on CNBC that they're basically really beseeching Trump to eliminate tariffs to avoid a recession. Yesterday we saw GDP go negative with this huge surge of imports. And what's interesting about that also is that the price index is kind of inched higher. So all of these things are creating like a real kind of negativity and an overall pall of negativity. Now there's this economist at Apollo Global named Torsten Slok, who's been basically saying for a while here that he expects that we're going to have a recession because there's going to be shortages and we're going to start to see large numbers of layoffs going forward in things like warehousing, transportation, and retail. And we might have started to see that with the jobless claims today. There are anecdotal reports of things involving California with the ports and stuff starting to see, issues. The ports not having, stuff coming in and workers and all that sort of stuff. And I think one of the longshoremen unions basically came out and was actually saying the same thing. They want Trump to stop the tariffs because they see it hurting their jobs. So I think it's important to realize we could be in a spot here where we have this big stockpile of inventory of stuff where these guys front loaded bringing stuff in. And then and so we kind of get through it for now. But then in a few weeks, we start to kind of see, then you start to get shortages and stuff. There's no real clarity on how things are going to be walked back or changed. And then we could kind of get into a spot when there start to be layoffs, there's uncertainty, prices are still high, there's shortages. All those things happening together could create kind of an economic some kind of gridlock or some kind of negative sort of environment that could get worse from here. And so I think that's just something now that we kind of see lingering out there. And I think the Fed sees it coming as well. But the thing is, jobless claims only they're still under 250,000. Unemployment might inch up tomorrow, but it's probably going to be under 5%. I mean, if it went over 5%, that would be nuts. So the thing is that we're in a spot now, like I've said before, where basically it's the anti-Goldilocks, where the data is not bad enough for the Fed to be cutting right away. But there are also signs of reasons why inflation might still go higher. And that kind of creates this environment. So, whenever the Fed has spoken more or less since December, it has been kind of unwelcomely, it's been hawkish in an unwelcome way. And so we might have that risk next week as well. Ever since December when they cut the rate, the number of rate cuts from 4 to 2, and then subsequent things since then, including, Powell warning about stagflation because of tariffs. So we go into that next week, and that's a reality. And that's very often, it could be very well where the market is actually focused on in terms of risk. All right, so another thing is that Trump has said that he wants tariffs to remain over the longer term in different ways. So we do also have that time in July of like when will we go back up to the rates of April 2nd. So we're going to get into a spot where on one hand it might be a kind of wall of worry when people just assume, oh, of course the tariffs will go away. And then people are just optimistic and the market runs up on that. That's possible. But the thing is that we have out there that ongoing risk that people, it's not clear exactly what will happen. So it's not to say that it's necessarily all out bearish. I do think, though, that the point is that as we get to the Fed, we could see a repeat of what we've seen in previous times, which is the Fed is not as dovish as people might like, and we get kind of back into that drama. All right, so those are the main kind of overall points that I wanted to make about the overall macro environment. As we look over here, some of the other points here that were just kind of interesting was I mentioned the GDP falling. Earnings estimates have come down, since the end of almost 2%. In the full year estimates in the S&P have come down almost 2% since the end of the first quarter. And so let's see, the consumer confidence had the worst expectations since 2011. So all these things continue to kind of see overall what we've seen. Now, one of the things that also I think kind of stood out to me was the Treasury has basically running massive deficits. I mean, they tripled their estimate of the amount of money they need to borrow. So whatever that means is just kind of an interesting sort of point. I want to just kind of point out. It actually suggests to me that the economy is weaker than we thought, but now we actually know. So my sense is really what happened is that essentially we are now kind of teetering on the edge of a recession here. That's essentially what we're looking at. We might be in a recession, or we might be entering one, or maybe we're just going to kind of squeak by with a quarter of real weakness. But I think the result of that is less tax collections, and then suddenly, wow, we have this huge deficit. So I think it's interesting to look at those refunding announcements by the Treasury Department. All right, so I mentioned all these different points here. All right, now let me see. So Apple and Amazon are tonight. I'm just seeing anything else I'm overlooking here. Let me go back to my charts now. All right, good. Let's go back to the charts and look at a few other things that are standing out I wanted to talk about. One other thing I do want to remind you of before we move on is that, remember, in MT Main, you can go, this is MT Main, go to key ETFs, now go over here to earnings dates. Now, don't forget that you can load a bunch of earnings. And let's go here, symbol list, let's just add the NASDAQ 100. And this will bring in this whole list. Never forget that this tool is available to you using the workspace that we share with you guys. Remember, it's up at the very top of the webinar, of the blog post. You can see downloads available here. In that is a zip file. The zip file has ELDs. The ELDs include indicators, special custom indicators. You want to load those into your TradeStation, and then you can load the workspaces. And in this case, you can see what it does is it basically tells you when the earnings are, and it allows you to kind of sort by things like, if you want to focus on the big companies, you can sort by market cap, you can sort by average options volume, you can sort by when they report earnings. So it's a great tool to have, and I never want anyone to forget how useful this can be during earnings season to use this page. All right, now some of the names that were popping up to me as I was kind of looking around that were interesting was I was really interested here to notice this is stock I've watched for a long time, which is NTNX. But this is just one of these. See, now as VIX goes lower, some of these kind of individual names, these smaller growth names, are the kind of thing that people might be looking to. In this environment, as the VIX goes down, now is when those smaller kind of individual companies can move. This has been Nutanix, NTNX. It's another, there's been a real dominance in software. Let's actually go over here to key ETFs. Key ETFs. And then now let's sort by our industries. Let's look in the last month. Look how software has absolutely triumphed and is the leading. IGV is the leading industry on a trailing 21-day basis. So what do we see here? We see very clearly software, and then at the sector level, technology. So what we see is, we're back to tech kind of leading overall, and I think that's just kind of interesting. I wanted to kind of point that out. All right, so that was a strength in software. So this was one that had stood out to me, Nutanix. I want to just kind of point this out because if you look at this on a longer sort of chart, this has been in just an interesting uptrend. And if you look, it's been breaking above this level from back in 2018. And if you look at it on the daily, you can see it really hasn't gone anywhere for like more than a year, really since the beginning of last year. It's been moving sideways, sitting at that 200-day moving average. Now, remember, during a lot of this time, software was really not doing very well. Software, look at IGV. It really didn't start performing well until the last 3 to 4 months. This was the breakout. Well, maybe back November. This was the breakout in software. This was the historic breakout above the bear market of 21. 22. See, this was the breakout. This was the high in late 21, and the breakout just occurred in November. So we're at a spot here where we could be starting to see outperformance again in software. And I think that's really interesting when you think about it, because semiconductors, they're not necessarily, the they haven't been doing like really lagging or anything, but the key thing is that they're more cyclical. If you're in a recessionary environment, there are those companies out there like Texas Instruments, or there is a degree of industrial economic exposure to semiconductors where the textbook says they're not great. There's also a lot of geopolitical uncertainty about export restrictions and all those sort of things. But software is a way for people to position for to do things with AI and this growth area. It's kind of non-cyclical economically. It doesn't have exposure to tariffs. So, it's a sort of sector. This market now is kind of like we saw back before COVID, when you had energy was down, you had cyclical weakness overall, but you had software names doing really well. And it's kind of like also we had in 2020, in the months after COVID. That's when a lot of these software names, look at software like it was doing back right after like right coming out of the pandemic. Oops, look at this. See, software was just just a huge rally there. So what's interesting is that in this environment, this sort of environment with a relatively, with a kind of weak, limping economy, software is an area people are looking to, and that's what we saw with something like Microsoft. So I think that's an important thing also to see here. Another one that's interesting is Salesforce.com. Now, Salesforce CRM, they are just now kind of getting above this high. It's interesting here. So from my view, this is a name that people might see a little bit of chopping and consolidation. And then as we get closer toward earnings, now things with the Fed and everything coming up, this might kind of chop and sit for a bit. But this might be something that, say we do have some weakness around the Fed, after that weakness, people might look for something like this, because with the software theme coming together, this is obviously one of the big names in software. Another name I wanted to mention, which is more obscure, but we've been seeing, I think I want to just mention Redfin, because there is a sign here. There is some evidence of an improvement in the housing market and overall purchasing activity. This is a major real estate brokerage. And someone mentioned Redfin, RDFN, and the other one is COMP, Compass. So if people are looking for the housing market to pick up, and say yields do kind of, stay in this area, and we start to see some activity, because there is signs now of prices breaking and activity kind of picking up, as we've talked about for a while. These names might be something people look to, Compass and Redfin. Now, I would also mention that I said these things about the economy and recession, all these things that we worry about, but I really want to emphasize that there are positives that remain in effect. Energy being negative is a positive. And then the other thing is that we are going to, like I've said, we're going to see, or there's evidence that we could see, and it's starting to potentially happen, is this real kind of crumbling and breaking down in home prices. And what that will do, that over time can really finally kick into the drag on inflation that really could put us in an environment where the Fed could be cutting, and we could actually be looking at rates, moving back under 4% on the 10-year, if that does happen. So I think we have to realize that on one hand, we have this situation with tariffs and everything else that creates a lot of kind of uncertainty and risk. But we do have these other deeper forces at work, which, if they're allowed to come back into play, could very well put us in a spot that that results in something that is more longer term positive. So those are the main things I want to talk about. So remember, after the bell say we have Apple and Amazon. Tomorrow morning we have payrolls. We have Exxon Mobil earnings. And then next week, Wednesday, we have the Fed. That's a big one. We will be back with State of the Market on Monday. And then we'll be back with market trends on Thursday. State of the Market is 2 p.m. Eastern. On Monday, we look at the sectors and the indexes in that. In this one, we look at the kind of individual stories, individual stocks. and more of the economic data. Hope everyone has a great weekend. I'll see you next week. Thank you very much.